you can invest in both public as well as private digital infrastructure. And when we refer to digital infrastructure, it's data centers, it's cell phone towers. Over the next 30 years, roughly 25.4 trillion devices will be connected to the Internet of Things. So that artificial intelligence offers a significant opportunity set in both public and private digital infrastructure. And that's a huge thesis in our investments for our clients.
Tao in Chinese simply means the way. As a philosophy, it is to find balance and harmony with the universe. Welcome to the Tao of Chao podcast. This is a podcast about macroeconomics, geopolitics, global finance, investment themes, retirement planning, and behavioral finance, where we will try to find balance and provide a clearer path forward in this uncertain world. I'm Philip Chao, your host. Each episode, I will feature an industry guest, a person in the trenches, a practitioner, to discuss a relevant topic in which my guest has expert knowledge and wisdom. Michael Underhill is the Chief Investment Officer at Capital Innovation and co-founder of the firm. Private Asset Management magazine named Capital Innovation as one of the best money managers for long-term performance. As a quantitative economist, Michael is a frequent speaker on topics such as quantitative finance, investment policy, portfolio management, and the risk characteristics of real asset investing. He's a regular contributor to Bloomberg's Market Sense program. Michael has published widely on international economics and financial topics, and is the author of Handbook of Infrastructure Investing. His academic work has been published in top academic journals such as the CFA Institute and leading think tanks like the Inter-American Dialogue. So Michael, welcome, and thank you for being my guest today.
Philip, my pleasure. Great seeing you again.
Thank you. Now, Michael, infrastructure is often defined as the basic physical and organizational structures needed for the operation of a society or enterprise. So I gave you a very brief background of you. Please tell us a little bit about how you got you interested in infrastructure and infrastructure investing, please.
Yes, so I look at the basic building blocks of society: water, sewer, transportation, roads and bridges, as well as railroads, and other types of utilities really play a fundamental role in the economic vibrancy and success of civilizations. Dates back thousands of years. I was fortunate from the perspective I had Dr. Shapiro at Penn State that studied economics and infrastructure development. So when I entered the business with my first opportunity at Lehman Brothers, underwriting water and wastewater bonds, as well as other types of municipal bonds, I understood the fragile balance between societal development, working with project finance, and the critical need for infrastructure financing for the success of any civilization.
That was really interesting. That you started really in the fixed income space and moving into specific investing in infrastructure.
Correct. So starting out with the municipal bond business, in 1992, and working my way through various investment firms, moving from municipal bonds, infrastructure debt, to infrastructure equities at places like Invesco, where they had a global listed infrastructure mutual fund, and being able to source, screen, analyze, and invest in publicly traded infrastructure securities. So think not only utilities, not only renewables, but pipeline operating companies, as well as publicly traded airports, seaports, and toll roads.
So when you and I talk about, or when you and your colleagues talk about infrastructure investing, it seems it's everything to do with infrastructure. It's not just road and bridges, or it's not just utilities, it's not just oil and gas, but really everything. How do you interpret infrastructure as you talk about it, vis-a-vis if I talk about it, I think about getting on the road. How do you think about it when you talk to investor or talk to others about infrastructure?
Well, Philip, I look at infrastructure plays a role in everybody's daily lives. From the time you get up to the time you fall asleep, you're interacting and using infrastructure. You wake up, you turn on the water, there's plumbing, that infrastructure facilitated the water that permits you to brush your teeth, shave and shower. You turn on the lights, you turn on your computer. That local utility is generating power that's sent through a transmission line that permits you to have electricity in your house, or conversely, maybe use solar panels to generate your power to light your home, to create heating, ventilation, air conditioning, livable lifestyle, if you will, as well as then, to your point, transport. There are toll roads as well as other public roads, but the toll roads that can carry you down to the airport, of which if I fly from Milwaukee to Washington, D.C., like I'm going to do this Wednesday, I have to pay money for usage of a toll road, pay money for usage of an airport to fly from Milwaukee to Reagan National. There are user fees, landing fees, TSA fees. So the economic underwriting of infrastructure has been going on for hundreds, I'd say almost thousands of years. Infrastructure as an asset class is only about 30 years old as an investment vehicle or investment tool in institutional investment portfolios.
So when you are looking at infrastructure, and as I look at infrastructure, I always used to think of it as really that's a public service, right? That's something that the government would do. But what you are saying in the last 30 years is really as much as government as it is private. What you think that it gave rise to that crossover of maybe public-private partnership, or maybe public to private? I give you an example. You mentioned coming to Washington area. Washington D.C. built a road that goes straight from the Washington area. There's a thing called the Beltway, go all the way to Dulles Airport, which is a number of miles away, 20 miles away from the Beltway. And then beyond that, there was what we call the Greenway, which is a private road that extend that Dulles access road further. When did all these private public come about, and why did it come about?
Great question, Philip. When you look at infrastructure finance, modern infrastructure finance, it happened roughly 30 years ago in a different country in Australia. And it happened under Prime Minister Kennett in Australia because they were going through a period in which the government had fiscal deficit issues, i.e. they couldn't afford to operate the airports, they couldn't afford to operate the roads, they couldn't afford to operate local water and wastewater utilities, despite the fact these were public assets that were critical or crucial to serving society publicly. So what they did is embarked upon an ambitious vision to structure public-private partnerships in which private developers, private investors may either own or operate or lease some of these assets. So Prime Minister Kennett sold off the freeways, sold off the airports, sold off some of the critical utility or infrastructure assets, in which Macquarie started buying some of these assets, privatizing them, and then would charge consumers a user fee for using the toll road. Now, these public-private partnerships, some of them were actually taken public in a listed investment company or LIC, similar to a stock in the U.S. But these Australian LICs are functioning today, in which you can see companies like Transurban, one of the largest publicly traded toll road operators in the world, responsible for operating toll roads in Australia. Sydney Airports, another publicly traded stock or listed investment company, and that's responsible for operating a series of airports within Australia. Moving through history from Australia under Prime Minister Kennett to Margaret Thatcher in the UK, when England went through their period of challenging sovereignty, fiscal deficit issues, Margaret Thatcher said, let's take a page out of the Aussie playbook and privatize Thames Water, privatize Eurotunnel, privatize and sell off some of these critical infrastructure assets to raise capital and try and stem the run on the treasury, as well as permit these infrastructure assets to be financed and operate in an efficient manner. So between Australia and England, you saw a preponderance of public-private partnerships, publicly traded global listed infrastructure securities. And that was really the beginning of modern infrastructure finance, of which today we have over 800 publicly traded infrastructure securities and almost $1 trillion of private infrastructure securities open-ended funds, closed-end funds, even direct project investment capabilities that's available for investors worldwide.
I don't think I can even count to 1 billion, let alone 1 trillion. So that's a lot of money. But from a global standpoint, that's like nothing. Is this sort of the beginning of a 100-year plus of continuation, as you see it, of more privatization? There are all kinds of reasons why the government cannot afford it. Is that what you see?
You've laid out with that question the conundrum we're dealing with not only in Australia and Europe, but globally. How do you adequately address the financing of critical infrastructure without raising taxes significantly? They'll need to raise taxes, but not significantly to the point that it's untenable for the consumer. How do you create a pool of capital, either equity or debt, private funds as well as public, and be able to offer these securities to investors in a manner that's packaged, attractive, and provides adequate risk and returns so that investors will be enticed to invest in these vehicles? And I think what you're finding is the infrastructure gap locally in the U.S. is about $3 trillion, i.e., the amount we need to invest to address existing water, sewer, transport, utilities, and energy is in that $2 trillion. Globally, it's closer to $15 trillion in terms of the gap, the amount that's being invested today and the amount that's required for additional investment just to make the roads safe to travel, just to make the water safe to drink globally, just to make sure the airports are safe so that we may travel without incident.
It's hard to talk about that kind of infrastructure without politics involved. So I think about in the old days, not old days, but 30 years ago, when we rely on the government to provide the basic infrastructure that's necessary, from airports to roads to bridges to water, sanitation to dams, all the things that you know about. And that's sort of the function of the government, and they're able to mutualize those financial costs through the government itself, which is a huge mutualized. It's an insurance company almost, right? They take money from everybody and they can issue debt, and they take tax dollars, and everybody benefit from roads regardless of where you are. To today saying, well, gee, maybe strategically we can, join forces by sharing the risks, and then instead of mutualizing by the entire country of 350 million people, maybe we'll mutualize it with 10 million people within the area and let them, not even all of them, only let the people who use it pay for it, which gets into this whole notion of it's not even about fairness, but about affordability. I know in Washington area, there is a Route 66 where they decided to charge when you go inside the Beltway to Washington, D.C., go to work, and it's not cheap. Is that the future that you see for infrastructure, where is a combination, but the problem at the end is affordability for the very people that they need to get them to work? I'm just using that as an example. And how do we as investors think about, gosh, I want to make money on this, but yet the affordability and the ability to sustain, or the sustainability of that model sometimes can be called upon. Any thoughts on that, Michael?
Yes, Philip. So you've touched upon another series of problems or challenges that infrastructure faces. But admittedly, when you start off a question with politics, I tell everyone all politics are local, all infrastructure investing is local. You have state, you have county, you have municipal infrastructure, as well as federal infrastructure. Those discrete problems are addressed at the local level, regional level, state level. And at the federal level, we've already seen politicians that cannot agree on anything except for one thing, that infrastructure investing is good for the economy and the consumer, and that for every $1 billion that's invested in infrastructure creates 42,000 jobs. So as you can imagine with politicians, their desire is to get reelected. And the best way to do that is create jobs, and create jobs. So that's why you've only seen infrastructure as the only bipartisan thing that's really accelerated vis-a-vis the Infrastructure Investment and Jobs Act, as well as last year the Inflation Reduction Act, which put another $450 billion into the U.S. economy, in which we're just starting to see job creation in manufacturing for batteries, manufacturing for renewables. You're starting to see equipment manufacturing for local utilities, and whether they're using gas, nuclear, or even renewables of that local utility, the equipment's harnessed as all of the different power generation and distribution parts and accessories have seen a massive investment from the government. When I look at the challenge around serving the consumer, the taxpayer, there will be touch points like a user fee model where the toll road becomes very expensive, and those may choose not to use that toll road and use a surface road or try and drive around it, even though it's more, it takes more time, it's more inconvenient. That's part of the infrastructure user pay model that's a little bit more challenging for the consumer. But conversely, there are areas like in energy and power generation where consumers benefit greatly from not only the shift from coal to natural gas, but more sustainable source of fuels like renewables, solar and wind. So there's a series of challenges by subsector of infrastructure, subsectors being transportation, utilities, energy, as well as digital infrastructure. All of those relevant sectors have different nuances, challenges, as well as opportunities. But I think what you're seeing is the current administration is starting to address things through the Infrastructure Investment and Jobs Act, as well as the Inflation Reduction Act, that's starting to lower power prices. It's starting to lower transportation costs. And admittedly, when you look at the railway system in the U.S., if we could move the needle on the railway system in the U.S., we could create a significant of cost savings, carbon emission reductions, and the ability to move passenger transport by 2 or 3% annually over the next 15 to 20 years is significant in the sense we'd actually create a trend not unlike the Federal Highway Act, where we'd see more population growth in not only urban areas, but in the rural areas vis-a-vis railway transport.
Interesting. I'm going to spend a little bit more time on this, and then I'd love to really get into the investment opportunities where you really shine. So I think about when I get on the Beltway in Washington, D.C. area, and they're doing all kinds of constructions. And one of the construction they're doing is to extend this sort of pay model through Virginia, over the bridge and into Maryland. And I travel like you do from time to different places, and I see a lot of gridlock in the lanes that you don't pay, and there's no gridlock on the lanes that you pay. So there are folks, I'm sure, driving on the non-paying lane is saying, gosh, all this money spent on these 2 other lanes that very few people drive, and I don't want to pay $7 or $10 or $20, whatever it is, to get on that thing. And we are suffering in the other remaining 3 lanes simply because we don't want to pay. So there are other ramifications of that. One is perhaps the model for how many people are going to use those lanes may not be accurate. And we'll talk about that. Perhaps you can help us to understand how one models the return of capital and the income on investment. That's one. Number 2, perhaps we should start thinking about, in the post-COVID world, where hybrid apparently is more permanent than at any time when we think about working, and that there may be ability for people to work less at the office. And so perhaps that will drive more digital infrastructure, and how we think about, when we think about these infrastructure investments, how does one think about the transmission mechanism, and what we think it is, it actually behavior tells us something different? I know it's a very long question. Hopefully it makes some sense, and get your thought on that.
So Phil, if I look at all those series of issues, challenges, but with challenges therein lies the opportunity. With toll roads, admittedly, there's a pricing mechanism, a user fee. That user fee is set by the operating company, the OpCo, for the tolling service. In industry nomenclature, it's known as ITS, or Intelligent Tolling Services. those companies, ITS companies, model traffic on non-payer lanes and then look at payer lanes, and they come up with a fee that ostensibly is palatable to the average consumer. Now, as you know, a data scientist like myself, we analyze these data sets. And the thing I'm qualified to tell you, there are lies, damn lies, and statistics. With infrastructure, it applies as well. You will have intelligent tolling services companies, vendors, that will increase the fee to the extent that there's a diminishing marginal utility or even the marginal propensity to consume that fee to commute to work and back. To your point, am I willing to pay $7 each way 5 days a week to commute to my job? The question there is there enough wage inflation? Is there enough economic growth that I can justify paying that $7 fee each way 5 days a week so that I can consume that as a consumer and bake that into my annual budget? To your point, in DC, it appears they've set that user fee model a bit too high because it doesn't sound like many people are willing to pay that fee. So the intelligent tolling services, that operating company, most likely will print poor earnings, poor revenue, and will be a poor investment. So whether it's a public company or a private company that operates that toll road, their financials will suffer. So this cuts to one of your other questions. When you look at investing in public and private infrastructure, the ability to glean the financials, doing the financial due diligence to understand their financial models, and how many cars are they modeling for the toll road? How many airplanes taking off and landing are they modeling for the airport? Or even with utilities and digital infrastructure, how are they modeling their cash flow and their revenue and their financials pursuant to the economy? Because this cuts to one of your other questions that you asked. The infrastructure asset class has subsectors where various sectors are economically sensitive. Airports, seaports, toll roads, very economically sensitive. Said another way, during the GFC, people stopped flying or significantly reduced their air travel. So airports saw their revenues go down. When you see other types of infrastructure subsectors like utilities during the GFC, for example, we were in I'd say admittedly not only a financial recession, but a depression of GFC magnitude. But people continued to flush their toilets and take showers, so utilities continued to generate attractive financial returns, whether we're talking stocks or bonds, or whether we're talking public or private infrastructure investments. Excuse me. So the underlying subsectors have varying degrees of economic sensitivity. So when we're heading into a recession, reducing your exposure to transportation, increasing your exposure to utilities may give you a better cash flow profile on your overall investment portfolio.
Talk a little bit about this digital infrastructure with all this excitement about AI, which is real. Maybe we are underestimating it, maybe we're overestimating, but nonetheless, we are doing more in cyberspace than doing less. Talk a little bit about how you think about digital infrastructure. What does that mean? Is it primarily private now, or is it both private, public, as well as private? What are some of the areas of intense interest? Share some thought on that.
Of course, Phil. So I look at digital infrastructure. Over the last 32 years of being an investor, you can invest in both public as well as private digital infrastructure. And when we refer to digital infrastructure, it's data centers, it's cell phone towers, the actual computing power that permits Moore's law to continue to apply every 7 years. And when you touched upon artificial intelligence, the significant power, electricity that's going to be consumed by accelerated artificial intelligence usage, as well as the data centers and cell phone towers that will continue to need to be built out to continue to support artificial intelligence as it continues to grow in an exponential manner. And so to your point about public and private, We've invested in bonds and stocks in the public markets. And if you were to take a look at data centers and cell phone towers, good examples are Digital Realty, Equitix, or even in cell phone towers, we look at SBA Communications, American Tower, or Crown Castle. So public markets, there's a whole host of data center and cell phone tower investments. In private markets, equally, you have anywhere north of a dozen to almost 24 types of equity and debt investments, specifically targeting data center, cell phone towers, and the digital infrastructure realm. So we can take advantage of this mega trend of digital infrastructure growth. And when I talk about a mega trend, over the next 30 years, roughly 25.4 trillion devices will be connected to the Internet of Things. So that plus artificial intelligence offers a significant opportunity set in both public and private digital infrastructure. And that's a huge thesis in our investments for our clients.
When you think about that, is it a bit of a stretch or not stretch to talk about satellite? Because satellite plays an important role in data transmission and in many other aspects to the digital economy. Would you include that in infrastructure?
Absolutely. It's in our portfolio. It has been for well over a decade, almost 2 decades. And whether we're talking public or private, there's a way to invest in satellites. And satellites continue to facilitate digital infrastructure, communications, intelligent mapping, as well as some of the global e-commerce phenomenon that continues to accelerate. So satellite investment in both public and private markets is something that we've done and will continue to do in the future.
For our clients, for example, we invest in REITs, which is in data center REITs or other type of REITs. We also invest in, of course, companies, public companies, who are in many of the areas that you are talking about, but not purely in that, but certainly I'm going to give a name, Google or Microsoft. They're very much in the AI space, and Amazon is very much in the cloud space through the AWS and all that. How do we think about infrastructure investing as a standalone sort of, I want to call it asset class or standalone way of investing vis-a-vis all these other parts that touch on infrastructure? Can you talk a little bit about how we should, from a framework standpoint, how do we think about infrastructure as a standalone vis-a-vis as we already have a lot of stuff in infrastructure related, not specifically and directly, but very much part of it?
So when I look at your question on its face, what is infrastructure? It's not just data centers or cell phone towers, airports, seaports, toll roads, other form of transport, utility, as well as energy and alternative energy and renewables. It's a whole host of subsectors that provide unique return, unique risk that's not duplicative of real estate, for REITs, for example. It's complementary to and provides a nice diversifier in a client portfolio. You're getting income, capital appreciation, and inflation protection. And when you look at the pricing power of utilities, one of the ultimate inflation protection vehicles is that pricing power. And that pricing power is passed on to investors that invest in those companies, whether they're public or private utilities. So they've got income, capital appreciation, plus inflation protection, which provides for a very unique investment return that's complementary to your common stock or bond portfolios.
You mentioned a couple of times private-public markets. And I think I know what you're saying, but I'm not sure I am able to always define that. We can think of private market as individuals who are non-government. We can think of private market as not public, meaning that is not listed. When you think about private and public, can you be very specific in terms of how we invest in private market, meaning either as listed or not listed, which is private away from government, which is, I think of it as another entity. I can talk a little bit about the different avenues, different ways to tap into infrastructure, as you have explained it.
And so when we look at public markets, there's roughly 800 global listed equity securities in the world. Market capitalization of those global listed infrastructure equity securities, a little over 3 trillion. When we look at public infrastructure debt that's available, publicly traded infrastructure debt, think about the municipal bond market, because all of those munis are focused on financing infrastructure. And again, that's a multi-trillion-dollar investment opportunity, large, liquid, publicly traded securities that are available on the exchange. You can buy them daily, weekly, monthly, fungible, liquid, with income and capital appreciation opportunities. When you look at the private markets, we're talking about private vehicles, private placements, of which there may be a infrastructure equity fund, infrastructure debt fund that's offered by a fund sponsor. So some of the larger names are KKR or Blackstone or Carlyle. And you're seeing these large fund sponsors go out and raise 8 or 10 or even $12 billion plus funds just so they can invest specifically in infrastructure. The LPs or limited partners that are funding those private vehicles and investing with Blackstone's infrastructure fund are pension funds, endowments, foundations, and other institutional investors.
But now today, those type of private investment, which used to be almost exclusively for those very large institutions, like you said, defined benefit plans, is now available to smaller investors in many ways. Can you talk a little bit about how that came about and how that works?
Sure. So we see a democratization of infrastructure vis-a-vis wealth management, retail investment vehicles. In particular, you're seeing things like interval funds, in which for as little as $2,500, you can invest in a daily value, daily purchase, quarterly redemption provision mutual fund of the 40 Act. And this vehicle, for as little as $2,500, would provide that investor with access to, admittedly, a portfolio would probably cost about $300 million to create if you were to invest directly in those private infrastructure fund or partnership investments.
And we understand the importance of infrastructure, I think, from what you have shared with us, right? You talked about really is so broad and so critical for a society to continue. It affects our daily lives in ways that we're not even cognizant of or take it for granted. And you can invest it from a debt standpoint, meaning that we will lend money to an entity, public or private, which will then use to purchase or to maintain or what have you of an infrastructure project. Or we can invest in equity player where we're actually buying the shares of that organization in hope of that organization, that entity will appreciate over time. Those are different risks. And is there a reason why one is preferred vis-a-vis the other? I would expect debt used to be the more popular way. And now, because of the private aspect of it, in other words, non-government entities are getting into infrastructure in a more meaningful way, or the commercialization of it, that makes direct investing into equities more available. Can you talk about the contrast? At the end, are we not all just looking for some kind of, typically in infrastructure, looking for income, much less appreciation?
Yes. So, Philip, you've hit upon a critically important investment challenge. Public or private, structure, vehicle, equity, or debt. Over the last 32 years of working with some of the world's largest institutional investors, we've seen them and helped them invest in multi-billion-dollar infrastructure equity investments, as well as infrastructure debt investments. Not coincidentally, we've also seen them invest in publicly traded equity securities. I'll give you an example. In Australia, they have superannuation funds.
Yes.
And one in particular called Future Fund invests $8 billion in global listed infrastructure. They do that not only to gain income as well as modest capital appreciation, but exposure to the infrastructure asset class through liquid publicly traded equity securities. They then draw down on those equity securities to fund their private infrastructure investments in both private infrastructure equity as well as private infrastructure debt. So even a large, sophisticated superannuation fund, institutional investor, uses both public and private, but for different reasons. If we were to take a look at the US and the wealth management market there, roughly 10.6% of individuals are accredited. The remaining amount, unaccredited. So it's very difficult to invest in private infrastructure as an unaccredited investor in the US. High dollar amounts or high minimums, $5, $10, $25 million minimums to gain access to just one private infrastructure investment. So I think that's been a challenge in the past. That's why listed infrastructure, vis-a-vis mutual funds, ETFs, or other packaged products, have been the preferred route for the mass affluent or the retail investor in the US. Not until recently in the last year have you seen things like interval funds that have packaged both public and private infrastructure into one wrapper where you can easily access the private infrastructure markets so you can generate returns, income, and gain access to a globally diversified portfolio.
It seems like private used to be, as you have mentioned, for accredited investor or qualified investor. Basically, what that means is that you have to have a certain net worth. You have to, in theory, have a certain amount of sophistication because of the investment is not liquid, it's not readily available if you need the money out right away, and that only the higher net worth individuals, families, organizations, what have you, that is more suitable for them. Not that they are better or worse, it's just that they can afford the lack of liquidity right away. But you have found ways, or not only you, but the system has found ways to intertwine private with public to provide the kind of liquidity that a not accredited investor would want, but still access private markets. So it seems like there's something special about private markets. What is it that makes private market more interesting, or are there investments that is exclusively available or more appropriate for private markets vis-a-vis public markets that we should be aware of, and thus the return should commensurate with private markets?
So when you look at the illiquidity premium, i.e. making more money for investing in illiquid securities, that illiquidity premium is typically 3 to 5% over and above publicly traded or listed infrastructure. Said another way, you can invest in the S&P Global Listed Infrastructure Index or an ETF to simulate a rate of return, which roughly is in that sort of 10 to 12% annualized return. Conversely, you can invest in private infrastructure in which you'll get another projected and forecast rate of return of about 3 to 5% higher than that index because of the illiquidity premium of investing in private infrastructure equity investments.
What are some of the things that we tend to think about private investment in the infrastructure that's more prevalent than public? Is it utility tends to be more public, but perhaps a data center is not? Are there a size and scale difference? Are there any industry specific? We're probably not going to be a private fund to build a dam, but we will use it for some other more siloed, more specific projects. Is that true, or am I misreading what private public can do?
So I think you touched upon an important point in which you look at large, complex infrastructure projects. So think heavy highway constructions, airports, seaports, toll roads. These are massive projects under the general heading of transportation infrastructure. Mm-hmm. Those historically have been the focus of private equity funds in the infrastructure space. And that's why you've seen some of the large firms, whether we're talking Blackstone, Carlyle, Goldman, for example, They focused on transportation as a significant aspect within their large global multi-billion-dollar funds that they offer to pension funds. Long-dated assets, long duration, 30 to 40-year contracts, which match well with a long-dated pension fund liability at a large public pension fund like California Public Employees Retirement System or even New York State Common Retirement Fund, for example.
Interesting. When you think about investment in infrastructure, how environmental factors and certainly governance factors play an important role, and can you cite an example how you view those roles and what actually transpired that was beneficial? Not because you have a ESG screen on investment necessarily, but it's part and parcel very much impact the return and the performance of an investment.
When you look at governance and sustainability, and even some of the environmental aspects of running a company, whether they're public or private, are a series of risk factors that we can all agree that we want to make investments in which the company's not polluting the environment excessively. We're not going to invest in a company that employs child labor. We're not going to invest in a company where the company's public or private has poor financial returns, yet the CEO gets paid a $40 or $50 million pay package. Excessive CEO compensation. That's an example of poor corporate governance. Said another way, if you were to look at just two publicly traded companies, and we'll use the railroad sector, for example, you'll find railroads have been underfunded, challenged to meet some of their operational challenges. And from a safety and compliance perspective, many of the railroads have had to invest billions of dollars of capital into their companies just to meet safety and compliance and regulatory issues of operating a railroad in the United States. Conversely, one in particular, Norfolk Southern, in the last 10 years has cut their safety and compliance budget by 40%. They've reduced their headcount by 20%. And they've seen their incidence of hazardous chemical spills increase by 600% in the last 10 years. Short term, their stock price benefited from the cost cuts. But most recently, with not one but two chemical spills in Ohio, Norfolk Southern was directly responsible for those. As a result of their underinvestment of safety and compliance, now they're subject to multiple lawsuits from both individuals, class action, as well as a state lawsuit that's forthcoming, in which it'll take a multi-billion-dollar hit to the company, and that'll significantly increase their liability, hit the stock price, and create a longer-term issue for the company. Conversely, Kansas City Southern has taken a different route of spending more money on safety and compliance, adding headcount to accommodate transportation growth. And when you look at their incidence of hazardous chemical spills and security, it's actually been reduced in the last decade. So when I talk about environmental issues, think about Norfolk Southern chemical spills. You talk about social issues. My mother lives in Pittsburgh. That's within the plume of that Norfolk Southern chemical spill that's infiltrated the waterways of 6 different states. And we talk about governance. Think about the CEO who made a conscious decision to cut their safety and compliance budget, to cut their headcount budget, but yet he knew and saw a 600% increase of hazardous chemical spills. But yet every year in the last 10 years, he's awarded himself stock-based compensation increase as well as a pay increase. So ESG is not just something that's a nice to have or something that may be applicable that generates additional returns. Sustainability is about doing more with less. And actually, ESG leads to some interesting risk factors that helps to manage and mitigate investment loss, whether you're talking public or private markets.
So when I think about allocating to an infrastructure investing vehicle, it ranges from something in space all the way to underwater. everything is possible within that definition. How do I go about thinking how much I should invest in infrastructure, and what should I be thinking about, both debt, and that could be through munis, as you have suggested. So I'm trying to figure out where the bleed through is and how I should think about concentration, so I know how much more or less I should be investing in, or what I should replace it with. So I give you an example. Again, commodity exposure, certain type of REIT exposure, and certain type of sector exposure can all have tangential, if not direct, exposure to an infrastructure fund. Whereas an infrastructure fund may have something very unique that is not available in all the other things that I mentioned. Can you give me a sort of a, if there's such a thing as a simple way to think about that, so I don't inadvertently double up on something or really have missed out completely on that asset class in other important ways?
So I think the first thing is to look at infrastructure and make sure that you're investing in a diversified vehicle. The reason being, if you're investing in just one subset, whether it's a data center, a utility, renewables, you're going to have a very cyclical rate of return with just one segment of infrastructure. Said another way, it's not like a bicycle wheel with only one or two spokes. You need a full array of spokes for a smooth ride. Mm-hmm. And having diversification across transport and energy and renewables and communications infrastructure, digital infrastructure, gives you a smoother ride to your portfolio and a well-balanced portfolio that can perform over capital market cycles 3, 5, 7, 10 years. And long-term volatility, a well-diversified portfolio by equity and debt, as well as subsector, gives, again, well-balanced approach, diversification, and a smoother ride, lower degree of volatility, with a certainty of cash flow, income, as well as capital appreciation. And so what we've seen in terms of your question around the allocation decision, there are many advisors, institutional allocators that have been managing for outcomes. Outcome number one would be income. Outcome number two, downside protection. Outcome number three is for growth. Outcome number one, managing for income, we've seen institutional allocators and advisors recommend a 7.5% allocation to infrastructure. Outcome number two, a downside protection asset allocation model. That downside protection model allocates 12.5% to infrastructure. Conversely, if you see a growth-oriented outcome asset allocation portfolio, it allocates 5% to infrastructure. So 7.5 for income, 12.5 for downside protection, 5 for growth-oriented.
Interesting. My final question for you, Michael, is regulation. Anytime we think about all the different areas you talked about, seems regulation has a role. And sometimes I think of regulation as being very stubborn and not very responsive, slow, and we may need faster regulations to accommodate, to adjust to the future. Is regulation sometimes slow, good, or bad? Or how do you put regulation into your overall thinking process, in your framework, when you think about, or when one thinks about investing in infrastructure?
So regulatory risk is a real risk that one needs to not only manage, but be rewarded for it as an investor. And there's different regulatory risk around transportation that's different than energy, that's different than utilities, that's different than digital infrastructure. All has unique regulatory risks, but also returns that are commensurate with that regulatory risk. As a portfolio manager spending the last 32 years in this business, there are unique attributes around risk and the return that makes it compelling to invest in the various sectors. But I think we can all agree less regulation in some sectors creates better investment opportunities. Conversely, there are sectors, railroads, for example, which may need a better regulatory framework or adequate regulatory framework to ensure the safety of the actual participants, the stakeholders, and the individuals. So I think regulatory risk is an answer. I would say it depends by the subsector, but as an investor, I want to make sure I'm being rewarded for the regulatory risk I'm taking of investing in any asset, equity or debt, public or private.
So that makes a lot of sense. And I guess when we go overseas, when we start looking at other developed countries or even developing countries, this whole thing, the scheme just changes even more complex, I assume.
Absolutely.
Thank you. Thank you very much, Michael. I know we are running probably beyond the time that we have allocated, but it's such an interesting and diverse topic that I think I'm not doing justice living within that time frame. So thank you for accommodating us. As we leave this conversation, what is that one thing that you would like us to remember about infrastructure investing that perhaps most people get wrong?
Yeah, I think it's infrastructure as an asset class. You not only invest for income and capital appreciation, but inflation protection. And I think that holy trinity gives you the diversification that's critically important in an investor's portfolio as we see the investment environment becoming more challenging, not easier in the future.
Thank you, Michael. This conversation has been so helpful that I'm going to remember to think about you every time I turn on the water, drive a car, go to the airport, fly to somewhere. I will be thinking about you all that time.
Thank you.
So thank you. Thank you for being with us, and hope to speak with you again.
I look forward to it. Thanks for the opportunity.
You can always find more episodes by visiting philipchow.us/podcast or find us on your favorite podcast app. You can always leave us feedback, ask questions, or request a topic for us to discuss by sending an email to pc@philipchow.us.
Views expressed in the Tao of Chao podcast are individual opinions, and they do not represent the employers of each guest or the firm each guest is associated. Our podcasts are for educational and informational purposes only and should not be deemed or viewed as investment advice or recommendations. Please consult your personal financial advisor, investment expert, or investment fiduciary before taking any actions about your plan and investments.